It is a really funny thing about grocery shopping these days. You walk down the health food aisle, you pick up a protein bar, and you look at the nutrition label.
Right, checking the macros.
Exactly. You see like 20 grams of protein, maybe 1 gram of sugar, some fiber. And on the surface, it looks like this picture of perfect health.
Yeah, it's clean, it's optimized.
Right. The packaging tells this very specific, very confident story about vitality and performance.
But there is a totally different label hiding behind that wrapper.
Yes. Because if you could turn that protein bar over and instead of reading the nutritional macros, you were reading the corporate financial label of the company that made it, you would not see perfect health.
No, you would see red flags everywhere.
Honestly, everywhere. Because today we are taking a deep dive into the Q2 2026 financials for the Simply Good Foods Company.
And even if you don't know that parent company name, you definitely know their brands.
Oh, absolutely. We're talking Quest, Atkins, and their recent plant-based acquisition, OWYN. And right now, their corporate metabolism is just severely out of balance. We're going to be looking at a stack of their earnings transcripts and financial presentations from April 9th, 2026.
And this isn't just some dry earnings report. This is a fascinating look at what happens when a massive health food giant hits a real structural speed bump.
Yeah, a huge speed bump.
It is a classic turnaround scenario. I mean, we are examining a company dealing with rapidly changing consumer habits, some deep integration struggles with a new acquisition, and a major leadership shakeup.
Right, which is why our mission today is to look under the hood of these financials. We want to understand not just what went wrong on the surface, but like the underlying mechanisms of why it broke down and how they actually plan to fix it.
Because you really don't need to be a Wall Street analyst to see why this matters.
No, not at all. If you have ever tried a low-carb diet or just grab a protein shake instead of a coffee, you can see how our collective, everyday consumer choices are directly impacting this company's bottom line.
Yeah, and the headline numbers from the second quarter are genuinely surprising. They really set the stakes for everything else we're going to talk about.
Let's get right into those numbers because they are rough. So Q2 net sales declined 9.4% year over year.
Dropping down to about $326 million.
Right, and their gross profit margins dropped almost 5 full percentage points, landing at 31.6%. But the number that truly jumps off the page, the one that made me do a double take, is a net loss of $159.7 million for the quarter.
Yeah, that is a staggering swing.
Right, because to put that in perspective, in the exact same quarter last year, they reported a $36.7 million net profit.
Exactly. Moving from a solid profit to a near $160 million crater. I mean, that requires looking past the day-to-day sales of protein bars and chips.
Yeah, you don't lose $160 million just because fewer people bought a peanut butter bar.
No, poor sales definitely contributed, but the bulk of that loss was driven by this massive $249 million non-cash impairment charge.
Okay, wait. Non-cash impairment charge.
Yeah.
That is exactly the kind of financial phrasing that obscures what is actually happening.
It sounds very clinical, yeah.
Let me try an analogy here. Tell me if I'm getting this right. It is essentially like buying a house at the absolute top of the market, right?
Yeah.
You pay a premium because you think, oh, the neighborhood is up and coming, property values are going to soar.
Right, you're projecting future growth.
Exactly.
So,
but then a few years later, you realize the neighborhood has actually changed for the worse. The foundation is cracking. And the house just is not worth anywhere near what you paid for it.
yeah.
Even if you haven't sold the house. On paper, you have to formally admit to the bank or to yourself that your net worth has taken a huge permanent hit. Is that what an impairment charge is?
That captures the mechanism perfectly, actually. In corporate finance, when a company acquires a brand, they place the value of that brand, so the trademarks, the perceived customer loyalty, the future earning potential, they put all of that on their balance sheet as a concrete asset.
Like it's physical cash in the bank.
Exactly. But strict accounting rules dictate that you cannot just leave that theoretical value there forever. You have to regularly test that asset against reality.
You have to check if the house is still worth what you paid for it.
Right. You look at your newly projected future cash flows for those brands. And during this second quarter of 2026, Simply Good Foods looked at the sober, revised future projections for two of their major brands, OWYN and Atkins.
And the projections were not good.
No. They realized those brands were mathematically no longer capable of generating the revenue they originally promised. So they had to take a massive write-down.
Wow. So they didn't literally write a check for $249 million that quarter.
No, the cash didn't leave the building. But $250 million of corporate value simply evaporated based on the reality of what those brands can actually earn going forward.
Which means we need to look at the execution gap, right?
Yeah.
What exactly is happening with these specific brands on the actual grocery store floor to cause such a drastic revaluation?
Because when you break down their portfolio, it is a very mixed bag.
It really is. You have this organic consumer growth clashing entirely with, like, forced failed corporate strategy. And I think the contrast is sharpest when you look at their anchor brand, which is Quest.
Quest represents 65% of their Q2 net sales, so it is the engine of the company.
A heavy lifter.
Yeah, and overall, Quest retail takeaway, which is the literal volume of product being pulled off the shelf and paid for by consumers at the cash register, that actually grew by 2.4%.
But the detail that jumps out to me is the split within Quest itself. It's almost like a tale of two different snacking habits.
How do you mean?
Well, Quest Salty, which is their line of protein chips, is absolutely on fire. It grew by 14%, and the company noted that the household penetration for Quest chips has crossed 10%.
Wow, so 1 in 10 households is buying them.
Yeah, that's huge. But then you look at Quest bars, which historically built the entire brand, and consumption there actively declined by 5%.
This split reveals exactly how fast consumer trends are moving right now.
Yeah.
Yeah, shoppers are aggressively seeking better-for-you alternatives to traditional savory snacks. They want the sensory experience of a crunchy potato chip, but without the carbohydrate guilt. And Quest just nailed the food science to deliver that.
But the bars didn't.
Well, the protein bar aisle has just become fiercely saturated. I mean, it's no longer novel to have a high-protein, low-sugar bar. There are 50 options on the shelf. Competition is just brutal.
Oh, totally. You'd stand there for 10 minutes trying to pick one.
Right. And Simply Good Foods admitted that the slowdown in Quest bars happened partly because they diverted their marketing focus and their investment away from their core product to deal with fires in other parts of their portfolio.
And that diversion of resources really helps explain the collapse of their legacy brand, Atkins.
Yes, Atkins makes up 24% of their sales. And the numbers here are just brutal.
Remember, this retail takeaway fell off a cliff, dropping 23.4%.
Yeah.
And going back to that impairment charge we discussed earlier, $62 million of that hit was specifically attached to the permanent loss of value in the Atkins brand.
Atkins is a brand that enjoyed over a decade of steady growth by relentlessly recruiting consumers to a highly specific low-carb lifestyle. They owned that identity.
Right, the Atkins diet was everywhere.
Exactly. But recently, the execution completely faltered. The company acknowledged that their marketing messaging became inconsistent. They kind of strayed away from their core weight management proposition.
Basically trying to be too many things to too many people.
Yeah, exactly.
And in the grocery business, a confused brand identity translates directly to lost shelf space.
Precisely. They suffered what they call known retail distribution losses. Grocery retailers only have so much physical shelf space measured in linear feet. They optimize every single inch of it.
Right. It's prime real estate.
Very prime. So if your product isn't turning over quickly, or if the brand no longer draws a dedicated shopper to that specific aisle, the retailer buyer will ruthlessly swap you out for a newer, faster-growing competitor.
So Atkins lost its sharp edge in communication, consumers stopped seeking it out, and the retailers just responded by shrinking their footprint.
That's exactly what happened.
So Quest chips are thriving on organic demand, Atkins is shrinking from an identity crisis, and then there is OWYN. That's OWYN, which stands for Only What You Need.
Right, the plant-based brand.
Yeah, this represents 9% of their sales, and honestly, this is the most painful part of the financials. They acquired this brand relatively recently. They financed it by expanding a term loan by $250 million back in June 2024.
A huge bet.
A massive bet. Yet, in this Q2 2026 report, barely 2 years later, OWYN suffered a massive $187 million impairment charge. The strategy completely unraveled almost the minute it hit the broader market.
To be fair, the strategic logic on the spreadsheet was sound. Simply, Good Foods wanted a fast entry point into the rapidly expanding plant-based, clean-label protein segment.
It makes sense on paper.
Right. It opened up a completely new consumer demographic. Younger, plant-curious shoppers that Atkins and Quest just weren't capturing.
But acquiring a brand for $250 million and then writing down $187 million of its value just 22 months later, that means the real-world execution failed spectacularly.
It did. The company cited very specific operational failures that caused this. They openly admitted to, quote, product quality issues and poor velocities behind their recent efforts to expand distribution.
Let's focus on that term for a second. Poor velocities.
Yeah.
Because that is really the lifeblood of consumer packaged goods. Velocity is the measure of how fast a product sells once it is physically placed on a store shelf. It is great for a corporate sales team to convince a major retailer, like a Target or a Walmart, to carry your newly acquired plant-based shake. That gets the product in the door.
But if those bottles just sit there collecting dust, your velocity plummets.
Exactly. And the domino effect of low velocity is devastating to a company's bottom line, isn't it?
Oh, completely.
Yeah.
When consumers don't pull the product off the shelf, the retailer sees a dead asset taking up valuable real estate.
And they want it gone.
Right. To get rid of it, the retailer forces the brand to fund heavy discounts or markdowns just to clear the inventory. Add in the product quality issues they mentioned, which, by the way, erodes consumer trust the moment someone takes a bad-tasting sip.
Yeah, if I buy a plant-based shake and it tastes chalky, I'm never buying it again.
Exactly. The product is dead in the water. Target or Walmart won't order a second batch. The distribution expansion just collapses.
And that is exactly why the future revenue projections for OWYN evaporated overnight, triggering that $187 million write-down.
Yeah, the math just doesn't work anymore.
You know, if you are listening to this cascade of bad news, declining bar sales, dying legacy brands, botched plant-based acquisitions, it is really easy to assume the entire healthy snack category is simply fading away.
It sounds like it, sure.
But that contradicts the broader macroeconomic reality. The purposeful nutrition sector is actually growing. But we have to address the elephant in the room here, the explosion of GLP-1 weight loss drugs.
Ah, yes. Medications like Ozempic and Wegovy.
Right. Millions of people are literally taking injections that physically reduce their appetites. They're eating significantly less food overall.
Yeah, that's the point of the medication.
So logically, you'd think a company that sells snack bars and shakes should be terrified of a consumer base that is quite literally losing its appetite. Yet the company claims this environment is actually a tailwind for them. How is that possible?
It is entirely counterintuitive, I know. But the physiological mechanics of weight loss actually make the math work heavily in their favor.
Okay, break that down for me.
So the company views GLP-1 adoption as highly consistent with the nutritional profiles of their portfolio. Yes, these medications significantly reduce appetite, leading to a much lower overall caloric intake.
Right, people are just eating less.
But precisely because users are eating so much less, the food they do manage to consume must be hyperdense in specific nutrients.
Oh, I see. They simply cannot afford to waste their limited suppressed appetite on empty calories or pure carbohydrates.
Exactly. One of the primary medical concerns with rapid weight loss from GLP-1 drugs is the loss of lean muscle mass alongside the fat.
Which is dangerous.
Very. To combat this, patients must aggressively prioritize high-protein, low-sugar foods. They need convenient meal replacements to ensure they are getting essential macronutrients without feeling overly full.
So a protein shake is perfect.
Yes. Simply Good Foods stated they believe there is a meaningful role for Atkins to play in a GLP-1 world, because a high-protein shake is exactly what a patient needs when they know they should eat but don't actually have an appetite.
Wow. What this data really reveals is that the demand absolutely exists. The cultural tailwinds of health, wellness, protein preservation, and convenient snacking are blowing stronger than ever.
The market is definitely there.
Right. So Simply Good Foods' issue is not a shrinking market. It is entirely a failure of internal execution and brand management. They're basically fumbling the ball while the stadium is packed with fans desperate for exactly what they sell.
Which brings us to the turnaround playbook.
Yes, the cure.
Right, because diagnosing the illness, falling sales, catastrophic write-downs, supply chain, and quality issues in a booming market that's only half the battle, we have to look at the prescribed cure and how leadership is restructuring the underlying economics of the business.
And step one in any classic corporate turnaround is changing the personnel at the top. In January 2026, they brought in a new CEO, Joseph E. Scalzo.
And wiping the executive slate clean was expensive.
Oh, very. The financials note $4.5 million in restructuring costs, plus another $1 million in stock-based compensation explicitly related to the separation of the prior CEO.
Scalzo's primary mandate, as heavily emphasized in these financials, is restoring the shape of the P&L, the profit and loss statement.
And the shape of a P&L isn't just corporate jargon, right? It describes the vital ratios that allow a consumer packaged goods company to actually survive.
Exactly. Historically, Simply Good Foods was a thriving, highly profitable business when their gross margins approached 40%, and when they consistently reinvested about 10% of their net sales back into marketing.
So 40% margins, 10% marketing. That specific ratio is the engine of a CPG brand.
It is the necessary formula for growth in the grocery business. A 40% gross margin means that for every dollar a consumer spends on a protein bar, the company keeps 40 cents in profit after paying for the raw ingredients, manufacturing, and shipping.
Okay.
And they desperately need that 40 cents because they have to use a large chunk of it, that 10% of total sales, to constantly buy advertising, social media campaigns, and premium shelf placements.
Right, because without relentless marketing, a brand quickly becomes invisible in a crowded aisle.
Exactly. But currently, that shape is entirely distorted.
Because of the inflation.
Yes. Inflation driving up the cost of whey protein and packaging, combined with the really expensive product quality issues at OWYN. Their gross margins have compressed down to 31.6% this quarter.
And when your margin shrinks that drastically, you suddenly don't have the cash to fund your marketing budget.
Nope.
So the marketing gets slashed, the brand loses its visibility, consumer demand drops, and you enter a corporate doom loop.
That's the fear. So to bend the financials back into a sustainable shape, the new leadership laid out several tactical priorities.
What's the first one?
First, they are demanding less reliance on price promotions. They have to stop heavily discounting the product just to temporarily boost the volume of units sold, because that further destroys the margin.
Makes sense. Stop putting everything on sale.
Right. Second, they are implementing direct pricing actions, which means either raising the retail price for the consumer or subtly shrinking the package sizes to offset the inflation of ingredient costs.
Shrinkflation.
Essentially, yes. Third, they are lowering their fixed corporate overhead. And finally, they are refocusing their innovation pipeline entirely on major consumer-driven ideas.
So they need to stop tinkering with tiny niche flavor variations and just get the core Quest bar velocities back up.
Exactly. Focus on the core.
Now, digesting all of this, the $160 million quarterly loss, the collapsed value of their recent acquisition, the CEO being ousted, you would logically think this company is teetering on the edge of bankruptcy.
You really would.
But the reality of their balance sheet tells a completely different story. They have incredible financial flexibility.
They do. Despite the massive net loss on paper, which, again, was driven largely by that non-cash impairment charge, their underlying cash generation and debt profile remains surprisingly robust.
Yeah.
They reported a ratio of their total net debt compared to their actual operational cash profit at just 1.2.
Meaning their total debt load is just over what they make in pure cash profit in a single year.
Exactly.
That is a highly manageable, healthy position for a corporation of this size.
It gives them a massive cushion. In fact, they are so confident in their ongoing ability to generate cash that during this exact same quarter, the very quarter, where they announced a devastating $159 million net loss, they spent roughly $89 million of their own cash to buy back 4.6 million shares of their own stock on the open market.
Wait, they bought back stock in the middle of this?
Yeah, $89 million worth.
That is wild. This is exactly like a sports team firing their head coach mid-season. They are on a terrible losing streak, the fans are panicked, and the media is writing them off.
Right.
But the owners look at the actual roster. They look at their underlying cash flow and their highly manageable debt, and they realize, hey, we still have championship caliber players. We have the resources to weather the storm.
Exactly.
So instead of panicking and selling off parts of the team, the owners actually buy more stock in their own franchise. They believe the broader market is pricing them like a permanent failure, when in reality, they just need the new coach to execute the fundamentals better. They are betting heavily on their own roster.
That is the ultimate turnaround bet. Management is signaling to Wall Street that their foundational brands, particularly Quest, are strong enough to survive this period of poor execution.
They're confident.
Very. The thesis is that if the new leadership can successfully adjust pricing, fix the supply chain quality, and restore the historical economics of the business, the profit engine will roar back to life before consumer patience runs out.
So, synthesizing all of this, simply, Good Foods took an undeniable heavy hit in Q2 of 2026. A $250 million write-down is a brutal admission of failure regarding the OWYN acquisition and the Atkins brand identity.
No doubt about it.
Sales are declining across key segments. and they are struggling to maintain their physical footprint in the grocery store. But they're also armed with a new CEO, incredibly strong cash flow, low debt, and a highly rational plan to capitalize on the GLP-1-driven demand for high-protein nutrition.
The raw materials for a full recovery are all sitting right there on the balance sheet. The outcome now relies entirely on the discipline of execution. Can they actually fix the product quality, rebuild the fractured retail relationships with grocery buyers, and tune their marketing message fast enough to capitalize on the macro trends?
And that leaves us with a provocative dynamic to consider.
Yeah.
I want you to think about your own habits when you're standing in the health food aisle. It took decades for a legacy brand like Atkins to build unshakable consumer trust in the weight loss space.
They practically invented the modern low-carb conversation.
Right. But in today's hyper-accelerated health market, a single year of inconsistent messaging or a single product quality issue with a new acquisition can erode hundreds of millions of dollars in brand value almost overnight.
It's scary.
Consumers are ruthless, and retailers are even more ruthless. So as the science of nutrition evolves at lightning speed, especially with the rise of pharmaceutical weight loss,
Yeah.
completely changing how we view food, are the legacy health brands of yesterday inherently too slow and bloated to survive?
That's the big question.
Will they inevitably be outpaced by the agile startups of tomorrow? Or can a legacy giant successfully learn new tricks and reshape its entire corporate metabolism for a GLP-1 world?
It is the ultimate tension between the massive scale of a legacy brand and the required agility of a modern startup.
It truly is. The next time you pick up that protein bar and check the nutrition label for sugar and carbs, remember to think about the corporate label hiding right behind it.
There's always a bigger story.
Always. Because understanding the complex, ruthless business behind the food helps us understand the food itself.